First, I want to start with a disclaimer. Currently, I'm working at whole tactical asset allocation. And because we do accept outside money, I have to put this in. So it's the standard sort of thing. All the opinions here are mine. They've got nothing to do with Hull. We're not making any solicitation or recommendations. And also, obviously, trading's inherently risky. You can lose money, and past performance, no indication of future success. So that's in there for legal reasons. It should also be in there for, if you don't get this, you shouldn't be in this presentation reasons, because these things, if you don't understand that trading is inherently risky, if you don't understand that it may lead to losses, you probably aren't cut out for this either financially or psychologically. Trading is all about nuance. So nothing that I say should be taken as absolute. So everything should have an implied generally or usually. So when I say something like, I don't know, options are overpriced, that doesn't mean options are always overpriced. It doesn't mean all options are overpriced. It just means in general, most options are overpriced. Okay, so having said that, let's move on to the interesting parts. I assume you want to know this. In order to be a successful trader, you need a strategy with positive expected value, you need good risk control, and you need the psychological makeup to stick to the first of those two bits. Expected value is by far the most important. If you don't have a good strategy, it doesn't make any difference how good your risk control is or how good your any intangible psychological qualities you think you have are. You are not going to become a good trader because you work hard. You're not going to be a good trader because you're dedicated. You're not going to be a good trader because you're disciplined. There are a lot of people who are disciplined and dedicated and work hard, but if they're doing something intrinsically stupid, they're still going to lose money. You can go and play the lottery in a very disciplined manner, and you're still not going to make any money. So risk control and psychology are important, given you have a strategy with positive expected value. And a lot of people get that the wrong way around. They think, they will say risk control is the most important thing. I mean, it really isn't. I mean, I don't know how to make that, I don't know how to emphasize this any more clearly. If you're not doing something where the odds are on your side, nothing else matters. It's like having good risk control and a bad strategy is like being a tough boxer. If you're a tough boxer, but you're not a good boxer, it just means you're going to get beaten up longer. You're better off if you're not good to be not a tough boxer, and then you'll get punched once and you'll fall over and you're out of the game. It's the same with being disciplined. If you're doing a losing strategy in a disciplined manner, it's going to be worse for you. You're going to stick around and you're just going to lose money in a much more consistent manner. Similarly, this sounds bad. Optimism is about the worst thing a trader can have. If you think that things will turn around, that isn't in any way help for you. The only way things will turn around is if you make them turn around. So, oh, and by the way, I do say psychological makeup is important. It is, and a lot of people have trouble with it, but you're much more likely to have psychological problems like frustration and anger if you're losing money. It's almost certainly a result of losing money rather than a cause of losing money. And if after all this, you're convinced, and maybe you are, I don't know, you're convinced that what's holding you back, your real weak link is the psychological part, deal with it like you would if you had any other real problem. If you have a problem and you know your strategy isn't any good, then you'll work on your strategy and you'll realize it's going to take you time and effort to improve it. You've got to do the same thing with psychology. You can't just look at a YouTube video or read a self-help book. You really need to address it. You probably should get professional help. Cognitive behavioral therapy would really help in that regard. A lot of people claim they have a psychological problem and then just don't do anything about it. I mean, to be fair, a lot of people, complain about stuff and do nothing about it in general anyway. But anyway, this is what you need, and that's the order in which you need it. So coming back to expected value, which the earliest known reference we have to it was a French reference, and they referred to it as mathematical hope, which I quite like as well because it has sort of seems more apt for a trader. Okay, so mathematically expected value means the weighted average of all your outcomes is greater than 0. So the canonical example is you've got a biased coin, comes up heads 55% of the time. So if you win $1 when you win, you lose $1 when you lose. The expected value for that would be 0.55 times 1 minus 0.45 times 1, or 10 cents. So over time, if you flip that coin enough times, you will win 10 cents per flip. Obviously, the result of any given flip cannot be 10 cents, but on average, that's what it means. It means on average. Now, how do you find that? Well, the thing that's not going to help is any knowledge that you think you have. Reading the Wall Street Journal or reading The Economist and then deciding to do a trade based on that is not going to help you. The hard bit about finding expected value isn't so much being right. It's being right and different from the market consensus. I mean, it's very obvious to everyone that electric cars are going to be the future. That in no way relates to thinking that buying Tesla stock's a good idea. You have to ask yourself, is knowing what we know, knowing what everyone knows about the future, is Tesla stock underpriced given all that? And you being able to back out based on your reasoning a valid answer to that is very unlikely. And now that's if you're an expert. There are some people, I have a friend who is on the board of a major pharmaceutical company, and she knows practically everything there is to know about the development pipeline of new drugs. And so she plays around a little bit with biotech stocks. She hasn't done notably well. And so even if an expert in a subject can't find edge this way, it's very unlikely you can. Now, even worse than that is if you've somehow convinced yourself you're an expert in something that you don't know anything about. The classic example of this is the Fed. Every trader has opinions on what the Federal Reserve is doing. This is, well, for an outsider, it would be very odd indeed. Now imagine if you're an engineer and you've been studying engineering at college for, I don't know, 5 years. You've got 20 years of experience. You do it literally every day. Now imagine if I've been watching a series of YouTube videos and I've read some stuff in the Wall Street Journal. And I come to you and I say, look, everything you know is garbage. I know how to do your job better than you do. Now, that is clearly ludicrous, but it's also what a lot of traders think is true about the Fed. Now, there's 3 possibilities about what the Fed does. The first is that the economy is completely unknowable to anyone. It's a complex system that literally can't be controlled or predicted. And in which case, the Fed doesn't know anything. You're right, but you don't know anything either, so no one knows anything. The second is that the economy is somewhat knowable, and the hundreds of PhDs that the Fed has working for them have managed to learn a very small amount about the economy. The third is that the economy is really trivial and you know more about it than the Fed. One of those is much less likely than the other. And this all comes back to a very good rule of thumb. If you found a situation where you're convinced that everyone involved in the industry is stupid, it's much more likely that you don't understand the situation. Doubting yourself is really important as a trader. I could be wrong about that, but I doubt it. That's my joke. A lot of traders are contrarians, which means they like to doubt, the established wisdom, and that's fine, but it's not nearly as important as doubting yourself. And a lot of contrarians are these people who doubt everything except their own opinions. Don't become that person. Okay, so these are the things that aren't going to work. Here are the things that will work. I want to be really clear here. The efficient market hypothesis is a real thing, and it's really very good. It doesn't mean, and it never has meant to anyone who understood it, that markets were perfectly efficient. What it means is that they are, to a good approximation, really efficient, and it's really hard to make money. So any edge you do find will be of one of these two kinds. It could be an inefficiency, or it could be risk premium. And it's really important to know the difference between those. I'll give you an example why. There's an old joke about two economists, so it's obviously not a funny joke. And they're walking down the street and they see a $100 bill lying on the ground. And one of the economists said, oh, look, there's a $100 bill. And the other one goes, no, there can't be, because if there was, someone would have picked it up. So that's the efficient market hypothesis. There's no money lying around. But in reality, there is. You will occasionally find a $100 bill lying on the ground. Now, the first thing to do is ask yourself why it's there. If it's Sunday morning and you're taking the dog for a walk and you've just passed a bar and it's lying outside the bar, it's very likely someone drunk came out, dropped it, and went home without noticing it. That's an inefficiency. That's literally something that no one else has noticed. The other alternative is you've seen the $100 bill and it's lying in the middle of a 4-lane freeway. Other people have seen it, but they've decided they don't want to take the risk of going to get it. That is a risk premium. Both of these are perfectly fine ways to make money, and actually you should try and do both, because an inefficiency is not going to last. If you find an inefficiency, the thing to do is trade it as aggressively as possible, as big as possible, and don't tell anyone else about it. Generally, you can tell people about trades, and it really doesn't matter very much. But a real inefficiency, you shouldn't. By the way, this is something that professional traders tend to get wrong. They'll find an inefficiency, and they'll say something like, well, I just want to make steady money, grind away, stay in the game, which is totally the wrong way to do it. The inefficiency is going to go away. Within, could be weeks, could be months, probably years. They don't hang around for decades. So the thing to do is maximize it. Whereas a risk premium is literally something, because it's there due to people's attitudes to risk, it's probably going to be there forever. So that's the sort of thing you can structure an entire career around. That's the sort of thing you want to do steadily, consistently. And like literally, I have been trading risk premium, the same one basically, for 25 years. And I have every confidence it's going to be there for the next 25 years. So if you can find inefficiencies and risk premium and make a little strategy portfolio, then you're really going to do well. That's the ideal. So typical risk premium include the equity premium, and the stocks go up, which is about the best, most well-documented financial fact there is. We've got evidence going back as far as stock markets have existed that stocks go up. You're being compensated for the risk of owning stocks by making money. And after dividends are accounted for, pretty much can expect to make 6 to 10% a year over the long run. So that's a risk premium. There's also within that sub-premium, like smart beta, they're called, factors like value, size, beta, and quality. And people will argue exactly what risk each of these is compensating you for, but it seems likely that, for example, small caps do better than large caps because they are also more risky. They may go out of business. It's pretty hard to imagine Apple going broke tomorrow, but a company with a market cap of 20 million doesn't have to have much go wrong for it. And the final one, which I believe a lot of you people are actively trading, is the variance premium, which is like what I've built my career around. The variance premium basically says that the variance implied by options is too high relative to the subsequent variance. Or, putting it another way, options tend to be overpriced. So the way I think Don alluded to the fact you trade this, a lot of you, is by selling iron condors. So you are selling net option premium. Because on average options are overpriced, on average that trade will make money. But here's something, and I'm not saying this applies to any of you, but it's very important to know where your edge is coming from. And it's not coming from the fact you're doing an iron condor. If you think that's the case, you're confusing the structure of the trade with the phenomenon that's driving the edge. And the phenomenon is that options are overpriced. Your implementation of that is through an iron condor. There's nothing special about an iron condor. You could have done straddles, you could do covered calls, you could do short cash secured puts, you could do butterflies, iron butterflies. There's a ton of things you can do, and they're all taking advantage of the same thing. I'm not saying the choice of structure is inconsequential. It absolutely is. The expected payoff from all of these structures has a different distribution. The important thing is, though, they all have the same average of that distribution. Over time, if you do straddles, if you do iron condors, whatever short vol strategy you do, if you do them the same size, they'll all make the same average P&L. What they won't make, however, is the same distribution shape. There's a lot of things you can do with options to change the shape of the distribution. There are far fewer things you can do to increase the average value of the trade. This is a very complex subject, and like I've literally, I think, got 3 chapters in my recent book about this. And there is no such thing as a perfect strategy. So sometimes people will ask me what strikes they should do for their condors. There's no answer to that. You choose the strikes based on a whole bunch of criteria. Depends on the win rate you want, depends on the drawdowns you want, could depend on the Sharpe ratio you want, all sorts of things. There's no right answer for this. The danger with choosing strikes that are a long way apart, so say selling, I don't know, a 5 delta, 1 delta iron condor, you're going to win that trade almost all the time. Now, that might not seem like a danger, but it really is, because you're not getting a very accurate statistical look at the true risks of that trade. Unless you're very carefully monitoring volatility separately, you're not going to be able to distinguish between luck and skill. And that is a real problem. So I like to do trades that give me feedback to tell me if I'm wrong. And I want to learn if I'm wrong really quickly. So that's one of the reasons if I was going to sell volatility, I'd almost always do things that are closer to the at the monies, like straddles. But like I said, that is purely a personal preference in that regard. So anyway, the variance premium is probably the king of all options trades. It's kind of like gravity. I'm not saying you can never make money being long options, but you are definitely flying against gravity. Okay, now I'm going to talk to you about a specific manifestation of that. It's something I'm looking at as part of a bigger project. We know the variance premium's there, but just like we know the equity premium's there and we break it down into sub-premium, I'm trying to do that with the variance premium. So the variance premium, very technically, is basically saying the implied variance swap is overpriced. And that includes all of the options on a particular underlying. But they're not all equally overpriced, and they all behave differently. So the variance premium you get from selling, I don't know, a straddle is not going to be exactly the same as the variance premium you'll get from selling a teeny put spread. You are doing different parts of the curve, and there are subtle differences between them. So that's what I'm breaking down. And in particular, the thing I'm going to talk to you about today is the skew premium, which is basically the implied volatility skew tells you normally that puts trade at a higher implied volatility than out-of-the-money calls. And we're going to show that that exists, and also it is different to the at-the-money premium you get by selling straddles. So I put this in and then realized I probably shouldn't, because I don't really refer back to it. The implied volatility skew is called the skew because you can use it to back out the implied skewness parameter of the distribution. So there is a way similar to the way the VIX is constructed. The VIX is basically a synthetic variance swap. There's a way you can do that to get a skewness swap as well. It uses, again, weighted average of all the options. But a decent approximation for that actually is this, this formula, which is just the difference between the delta of the 25 delta call, sorry, the vol of the 25 delta call and put scaled by the at-the-money and a normalization factor. That's actually a reasonably good approximation. And it's telling you that the risk reversal is priced in terms of the implied skew. So risk reversals are price reflections of the implied skew. So that's worth remembering. But on the other hand, if you don't, like I said, I probably shouldn't have put that slide in. This is important because there's a quoting convention here, and I thought it was obvious. And then I did this Twitter poll and found out amongst 900 people, it's very much not obvious. Traders almost always refer to the slope of the implied curve of an index, where the puts, say the 25 delta put has a higher vol than the 25 delta call. They will refer to that as being positive skew, simply because I guess positive numbers are easier to work with. But that is representative of a negative statistical moment. So it is telling you that there is a negative skew in the underlying implied from that. So this is always really important with every options trade. Whenever you're doing it and you're talking to someone and it matters, make sure you're on the same page. So make sure that if you're saying positive skew, the other person knows what you're talking about. Okay, so this is what I did. And again, this is about isolating a phenomenon. To do that, you want to do something that works when you do it in about the most basic way possible. So this is absolutely not the way you would actually trade this effect. What this is a demonstration that even using a very, very simple process, there is an effect there. So this is, because it's so simple, it's isolating this as a beta. A beta is just something you can collect. It's a risk premium. So for example, you all know about the stock market beta, which relates the return of any stock to the return of the index. So similarly, there is this beta that can be passively harvested through options, which is the variance premium. Beta is a thing that's there that you discover. It's available to everyone, but you have to know it's there. Whereas alpha, which is like excess returns over beta, is something you have to make. So as a trader, you identify the phenomenon here, which is a beta thing. And I'm showing you that it exists in a, I didn't optimize these. If I'd optimized them, obviously it would have been like the 23 delta or something. It wouldn't have just come out to a nice round number. But I'm showing you that in the simplest way possible, this thing makes money. So this is what I did. I sold one 2-month 25 delta risk reversal on SPY. So I'm selling the put, I'm buying the call, and I'm saying that the amount of capital I need for this is Reg T margin. So that'll be the margin you get in a very basic retail account. It's literally what the exchange demands you put up. And it's a fairly conservative amount because the exchange don't want to lose money. Often your broker will top that up. So they'll charge you Reg T plus something. But if you're a professional trading firm, you might also get portfolio margin, in which case those guys can pretty much charge you anything they like. So someone like, I don't know, Susquehanna is going to get much, much better margin terms than you are, which I guess is sort of natural. Anyway, so we're going to delta hedge this risk reversal because it's got a 25 delta put and a 25 delta call. It's a 50 delta structure, so I'm going to hedge it by selling 50 shares. I'm going to adjust this weekly because as the SPY moves around, what was 25 delta is not going to be 25 delta, so I have to adjust it. And then when we get to 2 weeks remaining, I'm going to flatten this position and I'm going to roll it into the next 2 months. And this is the result of that. Now, there's a lot of statistics you can use for analyzing whether a trade works or not. And you should use all of them. There's no such thing as a bad risk measurement. The Sharpe ratio, for example, a lot of people think it's stupid because it treats downside moves as equally risky as upside moves. It does, but if you know that, it's okay. It's still a valid measurement. It's still telling you something. There's information in it. It's much better for you to use a whole bunch of different measurements and know the weaknesses in each of them than attempt to find the perfect measurement. So there have been a whole bunch of ways of the Sharpe ratio being improved. In inverted commas, there's the Sortino ratio, the Kalmar ratio, there's alpha, which is a bad name because it's also used somewhere else in finance, the generalized Sharpe ratio. And again, all of these things add something, but it doesn't mean you shouldn't use the Sharpe ratio as well. So anyway, I'm not going to look at the Sharpe ratio right now. This is how you tell a trade's good. It starts here, low on the left, and it ends up here, high on the right. I'm not joking. That's the first thing you should do when you look at trading results. Statisticians make fun of that. They call it chi by eye, because instead of doing a rigorous chi-squared test, you just eyeball it. But if it doesn't pass the eyeball test, it doesn't really matter what else you do. So given this, when you're back testing stuff, you're going to be, kissing a lot of frogs. You just have to kiss a lot of frogs before you, marry a frog. But you have to start with this. And if you go through all of the tests and you look at if you don't do this, you're going to be wasting your time going through a whole bunch of other numbers. So anyway, these are my results. In 10 years, this thing started when I put my normalized initial account value to 100. It ended up getting to 180. Now you notice it hasn't done very well over the last few years, which is, it is what it is. And having said all that about chi by eye, here are the actual statistics. It's made 6.4% return, vol of around 5, slight positive skewness. The important thing is the Sharpe ratio is 1.18 and it has a maximum drawdown of only 5.4. That's really important. In a lot of ways, the smoothness of your results is more important than the actual return, because if it's smooth enough, you can just leverage up to make whatever return you like. And this is a very smooth P&L stream. So we're on to something good. Now we have to test that it's robust, because if it happened to only work for the 25 delta risk reversal, we wouldn't have much. But it actually, if you look here, it works pretty much every risk reversal you can think of. I haven't showed it here, but it works for pretty much any time period you think of too. So we could do 6-month options, you could do 1-week options. It's a very robust phenomenon. It's saying that puts are overpriced relative to calls. Now, it also works, by the way, for practically every index you can think of. So I looked at a whole bunch of foreign indices as well. And that's important too, because the more confirmation you have of an effect, the more confidence you can have that it's going to work going forward. Which is why the equity premium is so believable. I mean, like we literally do not have a period where a 10-year stock investment hasn't made money. Well, you can find it in a given index, but I'm talking worldwide. I want to point out something else here, and then I'm going to ignore it. So if you don't like, if you feel free to ignore it before I even start. You can see that the best is around the 25-30 delta risk reversal. This, it turns out, even though I said risk reversals are priced in terms of the skewness moment, the return on them has practically nothing to do with the realized skew, which is interesting because when you trade an option, you're selling an implied volatility, and that does have a relationship to the volatility of the underlying. There's a direct relationship between the implied variance and the realized variance, and your P&L is driven completely by the difference of those two. Whereas with a risk reversal, there's no relationship to the skew at all. It's priced in terms of the skew, but the P&L isn't driven by the skew. The P&L is basically driven by the correlation between the underlying movement and the at-the-money implied volatility. So what the skew is really telling you is how much does vol go up when the stock goes down. So when people buy puts, it doesn't mean they're stupid. It just means that they think that volatility is going to go up when the stock goes down by more than you do. Now, it shows you, these results show you that over time they're wrong, but again, that doesn't really mean they're stupid. It means they're paying more than something's worth, but not necessarily more than it's worth to them. You do this all the time. Every time you go into a retail store, you're paying more than something's worth, but you want it, so that's the price. So that's the same as with puts. Now, it turns out puts are statistically, as we can see here, overpriced. Okay, by the way, I'm not saying anything, I want to be really clear. I'm not saying anything here about teeny puts. We just don't have enough data to know if teeny puts are overpriced or not. So really, really small delta puts, like a 1 delta put, doesn't come into play often enough to know the statistics on it. It's kind of like you're really far out of the money strangles. We just don't know, which is why there are still raging debates over those who say it's overpriced versus those who say it's underpriced based on black swans. And frankly, neither of them have a good point because the statistics just don't back either of them up. We just don't know. We can make quite decent statements around, say, 10 to 30 delta puts, but in the wings, it really becomes a matter of your personal philosophy. And that is just something we're not, if I can't measure it, I can't predict it. So I'm not going to trade it. Let's put it that way. So the evidence we have would suggest teeny puts are probably overpriced because all the other puts are. But other than that, we don't know. And even if they are overpriced, I certainly wouldn't sell them just because my risk tolerance, it doesn't fit in with what I consider a good risk reward trade. Okay, so there is the risk premium here based on the risk reversal. It is completely different from the risk premium based on selling the straddle. So if you look here, this is what happened if you sold a 2-month straddle and you did exactly the same hedging method every week. You close it out 2 weeks before expiration. That P&L curve and this P&L curve are obviously totally different. So what we are looking here is a genuinely different beta. And that's useful because you can put it together with this and make a diversified portfolio. But why I'm doing this is because right now I'm trying to work in a Delta 1 environment where I'm trying to essentially improve an equity portfolio. And the cool thing about a risk reversal is if you don't hedge it, it's entirely directional. So you can stick it in an equity portfolio and improve things. So here is a 70-30 split between the spiders and my 25 delta risk reversal. So I'm literally replacing 30% of the directional exposure of the spiders with risk reversals. And as you can see here, I'm getting a slightly lower return, but that's because the return of that risk reversal strategy is lower than the spiders. On the other hand, I'm getting a much better Sharpe ratio, so I can more comfortably leverage this, particularly because the drawdown is considerably less. So the important thing here is the Sharpe ratio, which tells me that I can leverage this. Also, if I didn't do it here, but if you just look at the graphs, you'll see that even though this has a somewhat comparable volatility, it just in every other eye test is a much, much smoother thing. So here's my conclusion before you start yelling at me in the questions. Short risk reversals do have an edge. It's an independent edge to the variance premium, and both of them can hence be added to enhance an equity portfolio. So that's all I have to say. It's an example of how you can start to find a statistically valid trade. There are lots of things you can do. Now you've found that, you can work at ways of scaling in and out of the trade, because, little hint, if you look at it, you'll find it's very strongly mean reverting, so you can trade it like you would any other spread. You can play around with exact strikes, and you can see that it doesn't work exactly the same in all market environments. That's alpha. That's something that you personally can add, but the important thing is to add it on top of something that you already know works, and this is something that works. So thanks for listening. I guess now I'll throw it back to Dom to see what he has to say.
Tremendous, Euan. A lot of insights there that I think spoke to a lot of people. And let me ask a couple of general questions myself, and if I may, and then we'll get some other people involved. It's really one question that I just, it may be a little bit different between the way you trade and the way some people here trade. Am I correct that in your book you suggest that for traders who are perhaps not as professional as others, dynamic hedging or any form of adjustment, that's my question, may be best avoided?
That's a very good question. I don't mean that in the way that, you see people go on Shark Tank, and every time one of the sharks asks a question, whether it be good or stupid, they always say, oh, that's a great question, because that's what you're told to do in business school. I mean that, it's a really good question. If you don't do any adjusting at all, you're not going to be trading volatility. So for example, you sell the at the money, say the stock's worth 100, you sell the 100 straddle. If the stock goes to 200, you don't have any volatility exposure left. So if you want volatility exposure, you have to adjust your position, whether you adjust it through options or whether you adjust it through dynamic hedging. It's a different question, but in either case, you're doing the same thing. The tricky thing for everyone, actually, not just retail traders, is every time you do that, it costs money. And costs are a very insidious thing because they're always there and they're always small. So your daily P&L swings might be, I don't know, pick a number, $1,000. But your costs every day, could be only like $5. So you don't notice them on any given day. But that's $5 every day, whereas the $1,000 is plus or minus 1,000. So every time you trade, it costs you money. So the trick is to balance the adjustment with the cost. So you always want to balance what the adjustment's worth to you with how much it costs, which is a very difficult problem. And that's something pros don't do well enough either. Pros have lower costs, but they're still there.
There seemed to be excellent point. There seemed to be a whole bunch of so-called strategies being offered or being used and actively traded in the group or the community that we find ourselves in often, which comes out of certain educational organizations and other places, which consist of well, first of all, delta hedging, when it gets a little bit out out of delta and balance, but also putting on more aggressive hedges dynamically as the position, if the position moves sharply. In other words, certain people that seem to be very successful and have like stop orders and open orders to add, let's say, long puts or put spreads dynamically as the market goes down. Therefore, they're saved the cost of putting them on initially, and they get them maybe cheaper, maybe not later on, and they'll accumulate those. And in some cases, they seem to be able to do that to catch market crashes and so forth by that kind of just in time added hedge. But theoretically, that shouldn't work if we believe the efficient market hypothesis or theory. Do you think there's any chance it might?
Yeah, I wouldn't go so far as to say theoretically that shouldn't work. If you can definitively say that, then I'd say your theory isn't rich enough to capture what the real world's like. I don't, how do I put this? Every time you do a trade, you're making a prediction. So it's quite possible that given those traders' predictions, that is a good thing to do. It's nothing magical about adding to a position. And in fact, you shouldn't even think that way. What position you have on at the start is kind of irrelevant once time goes by. You should always be asking yourself, given what I know now, given what my best forecast is, what position do I want? And then if you don't have it, well, you do whatever you need to do to get it. So, you know, if the market goes down and these people decide they want to sell a put spread, well, I mean, that's fine, but it's a separate prediction that could well be right. Again, there's no magic about the put spread. Essentially, they're trading mean reversion at that point. So they're saying, given this market moved down, I think the market's going to go back up again. And you know, maybe they're right. There are certainly effects like that in certain markets. So all I'd say there is, it doesn't, to me, that's not intrinsically stupid. It certainly doesn't go against, you know, my view of the efficient market, which is that it's hard to make money, but not impossible. But I would really encourage you to stop thinking in terms of position adjustment or the worst one is repair. Because, you know, repair means you're going to fix something. But with a trade, you don't need to fix it. You can just get out of it and get into a new one, which is what you're doing. And that way you start with a clean slate rather than trying to sort of, you know, say, I've got this put spread, what do I do? Well, you don't like the put spread, get out of it. It's not like a family heirloom. You don't have to keep it.
Correct. So just to understand what you're saying, make sure I understand it. And you're saying that, and by the way, I was more thinking of buying a put when the market moves down, but your other example is equally applicable. But so you would say there is no real role for trading your equity? You should only trade the market and not your equity?
No, I'm not saying that at all. You should base the size of your trades on your equity all the time. And okay, so this is probably something that I can't explain very well orally, but I'll give it a go. Okay, first, you shouldn't ever have to be in a situation where you stop yourself out because you've lost money. If you do that, your initial trade was the wrong size. You should stop yourself out of a trade when you're wrong, i.e., if the market is now, if your forecast of future movement is different and inconsistent with your position, then get out. The money's gone. That shouldn't be part of your calculation. Now, there are times when you losing money is correlated with you being wrong. Like if you're a trend follower and you think the market's going up, so you buy something and it goes down, you are both wrong and you've lost money. But where it gets trickier is if you're a reversion trader, so you think things are always going to come back to their mean value, then as you lose money, you want to add to that position. Because look, if I think something's worth 100 and it's 95, I'll buy it. But if it's now worth 90, I want to buy more. I don't want to get out. So I've lost money, but I still want to do more. So you have to size your trades based not only on your equity, but on your strategy. So if it's mean reverting, you have to allow yourself to be able to scale in and out, because you don't want to run out of bullets when the edge is the greatest. So yeah, equity is really important. It's a major part of it. Has to be dealt with in context of your strategy.
Thank you. I'm not going to say too much more, but let me ask just one or two more quick questions, and then I'll open it up to everybody. Have you seen? I mean, we have the point being made here, and it's completely valid, or at least I think it is, that a lot of traders are trading very wrong. You mentioned both some professional traders as well as some less professional traders. They have misconceptions left, right, and center, and presumably these are a major handicap to success. Do you see some categories of, I don't want to say retail trader, but less professional trader succeeding? And what kind of trades, like we mentioned butterfly trades, we mentioned iron condors, we mentioned risk reversals. What kind of, do you see any pattern to the type of trading they're doing that is within reasonable grasp, that is with reasonable grasp that they can attain?
Yeah, I think anything that is based on the idea of harvesting a risk premium is going to work over time. So there's a lot of things you can, if you're buying equities and you buy on the dip, I mean, that's a good thing to do, but it's mainly a good thing to do because it's a good thing to buy equities to start with. So once that's your strategy, you've put yourself in a position where you're more likely to succeed. That's obviously a long-term thing, but that's the kind of thing you have to find. You have to find this general phenomenon and then base the micro bits of your strategy around that. So like, yeah, selling iron condors, you're going with the flow. That should work. And if you know why it works, which is because of the variance premium, then you can be like, okay, that's how it works. Now, given what I know, how do I make it better? So I really think in order to make something work, you should start with something where the tide is in your favor. And also, you've got to beware here that a lot of the things traders say, even really good traders, are just nothing to do with why they're good traders. So it's really difficult to learn from a trader just by listening to what they say, because what they do is correct, but the reasons they give you might just be stupid. So the example I'd use is if you're stuck in the desert and you need water, you don't want to go to the geology professor who knows everything about where water theoretically should be and how it's formed and what rocks to look for. You want to go to the tribesman who lives in the desert because he knows where the water is. He might have no idea why the water's there, but that's not what you're interested in. So there's a lot of traders who think they do one thing but actually do another. And they're good to know about, because it means what they're really doing is a really robust strategy. So if you can take that thing that is clearly working and make it better because you know something, you understand it, then that's a really powerful thing. So a lot of things the pros do like market making or stat arb or risk arb. I mean, these are all perfectly sensible strategies and they do work, but they're not very applicable for retail. So I think on the retail level, where costs are much more of a factor, and the difference between retail and pro isn't ability, it's basically transaction costs. And I'll include also in that the implicit cost of watching the market. Whereas if you've got another job, you can't sit in front of your screen all day. So that's an important thing as well. But anything that's involves buying stocks in the long run, or trading mean reversion in the medium term, or selling vol, all of these things are great places to start. It's one of the reasons covered calls have worked for so long. You're selling volatility, and you're combining two things that work. You're combining the equity premium with the variance premium. So it's like a portfolio of strategies. It's a great place to start. But unfortunately, a lot of people think covered calls work for the wrong reason. They think it's like, oh, I'm creating a dividend or something, or it's income or something. So the covered call will still work, but you can't improve something unless you understand why it's working.
Well, that leads me to, I think, will be one of my final questions before I open it up, and I apologize, but I'd just like to try and keep things in order a little bit. And that is your books, particularly the first one, I think, have a lot of math in them, and that's not necessarily an obstacle to everybody by any means. There have people here who have PhDs, but how much help is it, or to what level or depth of sophistication of trading does one need to get to before finding that math, the detailed math of the models of Black-Scholes, and of course, much more in depth on the strategies? Do you use it routinely? Do you find it helpful? Would you recommend people, understand modeling to that extent mathematically?
That's a little difficult for me because I've pretty much always done math. So for me, math is sort of language I speak. So it's difficult to know exactly when I'm using it and when I'm just kind of thinking in those terms. I don't, though, think you certainly don't need to know Black-Scholes to trade options. If you're going to start hedging, and you have to know about the Greeks and so forth, it helps to know the math, but you don't have to. There have been explanations of those things written that don't use the math. So I don't think mathematics is essential ever. It's helpful to know statistics because then you can really analyze your results properly. But the math behind Black-Scholes, which is stochastic calculus, I mean, you don't need to know that at all. You don't need to know how to derive Black-Scholes in order to benefit from the insights behind it. Really what they did is they took an observational insight that you can hedge an option and then mathematized that to come up with the value. So what you should do is say, wow, that's really clever. Now I've got a piece of trading software that does all that for me, so I'm good to go. So I use math. And it helps when you're reading papers, which I get a lot of ideas from. I mean, there are a lot of good published things out there, but you can also, if it's a good paper, you can read it by sort of reading through the equation. You should be able to, well, I certainly try and write so that you can not have to understand the equation. You can just go from paragraph to paragraph. And I think that's the important part.
Very good. Let me pick up on a couple of questions we have in the transcript or the chat, if I may. Let's see. Okay, here's one from Samir. If you notice a huge skew develop in an asset, would you, and I know you mentioned finding edges, Euan, that are limited in time. If you at some point noticed a huge skew developing in an asset, Samir says, would you build a trade off it right away? What is your process?
That is a very good question. In indices, I can pretty much tell you, tell me the at-the-money volatility level, I can pretty much tell you the volatility level for any delta option from that, because the skew is so stable. Now that implied skew number does move, but it doesn't move very much. So in that case, if the implied skew goes up a bit, then I'll sell more risk reversals. If it goes down a bit, then I'll buy some back. So you can trade that as a mean reverting process very successfully, very easily. That's a really easy way to improve this trade. With single stocks, it's much more nuanced. And there's a lot of studies out there on it that they've shown that there is certain predictive power if you see a big implied skew move. To be honest, I don't trade single stocks enough to know what that prediction is of, but it is out there, it's been studied. So if you're going to do that, yeah, there's information in it, definitely. I couldn't tell you what the information is. People have related it to directional moves as well. It's like, you know, the old, it's called the put-call ratio. Well, the put-call ratio is basically a contrarian indicator, right? It's telling you that if people buy lots of puts, market's overdone and we're going to rally. Well, if people buy lots of puts, it means the skew is going to be steeper. So typically, if the skew steepens, you would make a bet where you're selling volatility and you think the stock's going to go up. But again, that would depend very much on the individual underlying, particularly with commodities. Commodities, you probably want to know the fundamentals. With stocks, probably doesn't even matter that much.
Let's see. A couple more. Do you have time for some more questions?
Oh, yep, I'm good.
Oh, great. Here's one from Jay Hansen that's a bit specific. In your book, you said a long risk reversal with a teeny for hedge was one of your favorite long strategies. What principles do you apply to select the teeny strike? Do you put it on for a net credit? And how do you decide when to close the trade?
Okay, so that's all really related to what I've just talked about here. Okay, so there are theoretical ways to select the strikes. A friend of mine, Arta Sepp, has written about this, published it, and we're currently working on some stuff together, but it's difficult because he's in Switzerland. He's shown that the profit here is linearly dependent on the VANA of the option. So the VANA of the option is how much the delta changes as the spot changes. And given the implied skew, you can find the options with the greatest magnitude of VANA. And those would typically be the best ones to trade. So that would depend on exactly how steep the skew was. Typically, you're looking at options in the 15 to 25 delta range, but it depends exactly on the steepness. So that's how you would find it theoretically. And then honestly, you just test it, see which ones work the best. What was the other question? When would I close it? Was that right?
Right.
That's trickier. Generally, the place you would close an option is if it's a short option, you would close it as late as you possibly can, because the variance premium in percentage terms gets greater and greater. So you don't want to be buying back a teeny close to expiration. Sometimes you have to. So you only close those shorts when you have to due to margin. With a long, you have to make the trade-off, sorry, you have to balance, is the cost of carrying this now bigger than my expected edge? So if you think like the market's going to go up, I don't know, 1% a day, and you've got a 50 delta option, you expect that option to go up 50 sorry, well, 1%, just say it's going up $1. You expect the option to go up 50 cents. But if it's got an 80-cent theta, you're expecting, based on, what you're expecting to lose 30 cents on that option. So at that point, when the theta is overwhelming the amount of edge I think I have left, that's when you'd get out.
Okay. Oh, he did ask, would you place it at a credit?
Well, typically you always do, because when you happen to look at the strikes, you're almost always selling puts at a higher price than the calls you buy. In fact, for an index, I don't think I've ever seen a situation where you're not getting a credit.
J. Crew was asking, did you make, I'll just read it as he wrote it. Who wrote the paper you're talking about now? I missed the name. I think I'm not sure if we remember anymore.
The paper I just referenced about the theory of the risk reversal, that's ARTUSEPP, ARTURSEPP.
Thank you. Yeah, I'm sure that's what he was referring to.
It's on SSRN somewhere.
Okay.
He hasn't actually published these, they're working papers.
Excellent.
He's tidying up the theory and it's going to appear in something we're working on right now. But yeah, it's on there.
Jay, why don't you look it up and post the URL if you feel like
his notation is awful, by the way.
And while we're talking about papers and books, Alexander Ivanovich asked, besides your books, what communities, paper sources, code sources would you suggest?
In terms of papers, SSRN is by far the best. It's got a really good search function. I also search there literally once a week, I'll go in there and I'll type in option and see what papers contain that in the abstract or the keywords. And I'll see which ones came out last week. And I'll do that for a few other keywords like VIX, volatility. So SSRN is probably the best for finding new stuff. Google Scholar is good if you're looking for something particular. And one of the things I like to do on Google Scholar, I do this at the weekends because I'm a huge nerd. Find a paper you like, type it into Google Scholar, and then look at all the papers that have cited that. And that's quite a good way to find new works. The archive, arxiv.org, I think.
Yes.
The quant finance section in that now has become very computational. There's a lot of stuff on machine learning and neural nets and stuff. And I'm not saying that's not valid, but it's difficult to get insight from it because you're literally talking about black boxes in a lot of cases.
Yeah.
So it's not as good as it used to be. In terms of code, I don't know, to be honest, because I don't really use anyone else's code. Internally, we use, we have our own stuff written in Python and R, and I tend to use that and a lot of legacy stuff that I've got in VBA still.
You mentioned machine learning. I noticed you had some venture in that area, I believe, or have. What is your overall opinion of whether machine learning can have any relevance to our type of trading or any type of trading?
Well, it absolutely can, but it's a technique and you have to be really careful you're applying the right technique to the right problem. Like this, in a lot of ways, you look at the archive, for example, and you'll see a machine learning paper applied to trading, and then you'll note that it comes out of the physics department of somewhere. That's probably a case of someone who's got a hammer and decided the problem's a nail. And we've seen that a lot over the years. Like before I got involved, the big thing was catastrophe theory, and that was going to make everyone rich. And then it was chaos theory. And then it was neural nets and genetic algorithms. And everyone gets wildly excited about these, and the excitement never pans out, but they become solid mathematical techniques, like a neural net, for example. I mean, it's exceptionally good at some things like pattern recognition, reading barcodes. I mean, the world wouldn't be the same without them. But they're not very good at predicting stock prices.
No.
So it's a matter of using the right, finding a good problem. So machine learning is absolutely a useful skill. Not sure it's the most useful. I think you can get by without it. I don't know of any, for example, really successful trading. None of the big trading firms are basing trading decisions on it. I mean, the option trading firms.
Really?
Well, they're using it to enhance things that they do already.
Right.
But they're not just setting a machine learning algorithm loose and having it buy and sell stocks.
Well, that's fascinating for me to hear. Who else would like to chat with Euan for a minute while we have him here? Sometimes.
Do you want me to look at these chat questions, or are you doing that? Are you curating these?
I've been through most of them. You're welcome to check for anything.
I'm happy to read.
Go ahead, John.
I just typed in. This is John. Thanks for joining us, Euan. In your opinion, what would you say the best way to fully utilize the available cash of an options trading account would be, given that many options trades necessitate small sizes due to, say, large risks associated with those trades?
That's a really difficult question. I mean it's a difficult question because it doesn't really have a good answer. One of the problems I have, it turns up a lot, right, is you have a strategy which involves using some money, but you don't know how many of these trades are going to turn up at any one time. So there's something I'm doing now, which you'll get a signal in it maybe once a week, but it's got a holding period of like a month. So you don't know how many of these are going to turn up and how many you're going to have. So you get into a really tricky situation as you don't know how to size things because you don't know what your future opportunities are going to be. So honestly, I'm not sure I can say much about that. It's a really difficult problem. I don't really know what the answer to that would be. I mean, if you know you're always going to have these positions on, then it's easy. You just allocate the margin in the size that you want. So, you might want to allocate, I don't know, 80% of your margin to short VIX futures and 20% to, I don't know, whatever, 20% to something else. But generally, life's not that, it's not that simple. So sorry about that.
Sure.
If you find out, let me know.
Yeah, appreciate it.
One question I see, I don't think we're going to be able to get to all of these. I think some of them might be better discussed afterward among ourselves, and we'll come back to those. But Steve Potensky, or I hope I'm Potensky, asked, do you do a lot of VIX term structure trading?
Okay.
I think the answer is yes.
I trade the VIX. So if you're trading the VIX, you have to be taking term structure into account. A friend of mine, Crilly Dollinger, was one of the first people to work on this, and we kind of worked on it together. He called the strategy the Mojito, and that was basically a term structure, ETF trade. And that was, I don't know, 2008 or something. And Simon and Campesano's paper was similar time. But it's like one of those things, right? I mean, a whole bunch of people sort of came up with this at the same time because the idea was there in the ideaverse. Yeah, if you're trading the VIX, you have to be aware of what the term structure does because it's a real effect. And it's one of those effects, actually, that's really good because it's a mathematically driven effect. So you know it's going to be there. Where you get into trouble, though, is, 10 years ago, when people were trading VXX or any of the other VIX ETFs, they had no idea about the term structure. Now everyone thinks about the term structure, and it's kind of gone from underrated to overrated. It is an effect, but it's not the only effect. So you can calculate exactly how much, given the term structure, the decay should be each day. But there's other effects going on as well. So yeah, you do have to take it into account, but you have to take it into account along with other stuff. I mean, most notably, what the VIX futures themselves are doing on their own, although there's a term structure there as well, and what the VIX is doing. And also the VIX on a short-term basis is basically driven by the S&P. So it's one of those cases where you've got to make your trade based on what you're really predicting. So if you're like, for example, yesterday, I tweeted about this morning actually. Yesterday, if you're like, vol's overdone, I'm going to sell some of these VXX ETFs. Okay, so you're saying vol's overdone, why? Basically because you think the VIX has gone up too much in a day. But that VIX spike was driven almost entirely by the fact that the S&P went down. So it's probably better in that case to just buy the S&P, because otherwise you're fighting against the term structure in VXX rather than using it to help you. So I guess, yes, I do. Yes, it's important.
Very good. Ron, did you want to ask? I know you had a couple of questions in there. Do you want to ask them yourself?
Can you hear me?
Yeah.
Yes, I can now.
Great. Hey, Euan. I really just had one question. I was curious with your backtest that you showed. Does each data point on the equity curve there represent end of trade P&L, or did the summary stats also account for intra-trade drawdowns and when you're looking at max drawdowns and Sharpe ratio and so on?
Oh, you mean these little dots here? Each dot?
Yeah. Does that account for intra-trade?
That's end of day.
Okay.
Also, I can't remember because we've done this a million times in lots of different scenarios. I'm not sure if this includes transaction costs or not. It doesn't make a huge deal of difference for the SPY because transaction costs are so low, but that's something you'd want to take into account as well, obviously.
Okay, thanks.
I like your avatar, by the way.
Very good. Let me see. There were some others. Mark, what was your question again? Oh, yeah. Do you do anything with positive Vega trades?
They're a lot harder to find, aren't they? Because you are swimming against the tide. Let me think. There are some. Try and find a couple of examples. In general, you can find short vol trades by looking at statistics, because you're literally making the bet that the future is going to be just like the past. Whereas with long vol trades, you're normally making the bet that something new is going to happen, something that isn't priced in based on the past. So you can't just do time series analysis to find it. I think the only one I can think of at the top of my head, and it does happen, VIX puts, based on the downward drift driven by the term structure and VIX mean reversion sometimes, VIX puts I quite often am long. Not when the VIX is at 13 or something, but if the term structure is favorable and the VIX is say 24, 25, being long VIX puts is a good trade. If you're long, I do want to say you're better off buying long dated options because the variance premium out there is always lower. So even if you don't think there's a variance premium, because if you think, for example, like I think those puts statistically are cheap, you still will get a better deal with the long dated ones. The other place that I sometimes buy options is in earnings plays for single stocks. It used to be that stocks where analysts were pretty much all in agreement about earnings would have much bigger moves, because essentially any miss was a surprise. So it was literally not going to be baked into the option price. That doesn't work as well as it did 10 years ago. I mean, what does? But that will sometimes be a situation where I'd go long. Also, single stocks, they generally have a variance premium, but it's some classes of stocks don't seem to. So it seems like options on growth stocks have a much lower variance premium. So that sometimes leads to long vol opportunities. But that's a much, much less explored topic than, say, time series analysis, which is probably a good place to work, actually. If I had nothing else to do and could sit down and do whatever I liked, I'd probably look at volatility related to fundamentals of stocks. So it really, I think there's like 5 papers written on that. There's probably a lot to learn in that sphere that hasn't been pumped out yet.
Okay, let me just see. Oh, here's a simple one from Gurkaran Aurora. In your opinion, in what order should one read your books?
I would go option trading, volatility trading, positional option trading, with the caveat that volatility trading is largely aimed at market makers because it discusses dynamic hedging in quite some detail, whereas positional options trading is mainly for quantitatively oriented buy side. So people who will be trading options but don't want to be actively managing them as much. And the amount of background you need for vol trading and positional option trading is probably similar.
Mark was wondering, well, I know the answer to this, but about calendar spreads. Do you look for, his question is, he meant to ask about calendar spreads. Do you do many calendar spreads?
I don't, and I probably should. When I was doing the last book and running simulations about what happens under various circumstances, calendar spreads had a lot of interesting things going on that I hadn't, it sort of surprised me. Coming from a market making background, calendar spreads are really dangerous trades because a lot of market makers will do a trade, say, a 2-year, 3-year straddle swap. Because frankly, a 2-year option and a 3-year option, kind of the same thing. The problem is when you get close to expiration and that becomes a 1-month option against a 1-year option, you have all sorts of problems. And I've seen so many market makers get into such tangles with positions like that that I've kind of tended to avoid them. And I think that's a mistake. I think as a positional trader, there's probably a lot of good things you can do with them. Which, to be honest, I really haven't.
Okay, Ruben Brooks says, for VIX volatility or index trading, do you find value in incorporating information beyond price and volume of the different instruments, e.g. macro indicators or proprietary data feeds?
Okay, so there are in some cases, yes, like if you're going to price S&P options, knowing about, say, the VIX options, the Skew index, they can be useful pieces of information. So there are sometimes things that I've linked like that. As I said, I would like to get more deeply into looking at the way stock volatility is related to fundamentals. So how stock volatility changes with the P of the stock or the size of the stock or the industry and all that kind of stuff, but I just haven't. I think there's a lot in there. I mean, I've got my intuition, which could well be wrong, is telling me that that's a really good place to look. But I'd really say the cross-index stuff, sure, yeah, and the VIX with index stuff. I mean, you can, if you're going to make like a Garch model for predicting vol, you can certainly include, you can make it multi-dimensional and put in, you know, VIX as well. So I often do that kind of thing.
Ah, and that's very interesting. Well, I think you're going to have to go fairly soon, I assume. I realize you're running hedge funds and everything else.
Well, yeah, not right now. I'm not. No, I'm good for a bit longer.
Okay, great. Well, we got a couple more questions here. And let me just see. This person.
Do you mind if I ask something, Don, while you
Please do.
Euan, one of the questions that was asked before, I think, wasn't perhaps interpreted in the way that I think that it was asked, and by this other person, and it was that question that they asked you about doing a risk reversal and then buying a teeny. The question was actually about how are you choosing that teeny, whereas your answer was regarding how to choose the strikes based on Vanna for the risk reversal?
Yeah, okay, sorry about that. They are very different processes. So that's a situation where first you get the edge, then you get the hedge. So the edge is coming through the risk reversal strikes, the 25 delta, say. But obviously, if you're short 25 delta put, it's completely rational to want to cap your downside. So you buy a teeny put somewhere below that. That's fine. The thing is, at that point, you're doing a trade that you know has negative expectation. Everything you know about the variance premium, and even the fact you've sold a risk reversal in the first place. You know, you're saying that the 25 delta put's overpriced. Well, probably means the 5 delta put or the 2 delta put's also overpriced. So you're not doing that trade for the same reason. So what you have to do there is, well, you don't have to do anything, right? But what I do is I'll literally say, how much money am I prepared to lose on this? And you don't put probabilities on that. This is one of those situations where you have to have completely, incompatible thoughts in your head. When you're doing a trade to get edge, it's all about probabilities. But when it's a hedge, the probability of the bad event doesn't matter at all. What matters is the outcome of the bad event. You know, like, okay, the S&P's never gone down 50% in a day. Could it? Sure. It just hasn't, but it certainly could. It's very unlikely that we've seen the biggest crash ever. You know, it's like going fishing and thinking the biggest fish you've ever caught is the biggest fish that could possibly exist. So it doesn't matter what the probability of a 50% drop is. It matters, can you handle losing that amount of money? So that's what I do to choose that's what I do to choose the short strike. Sorry, the long strike. Just choose the amount of money that I'm comfortable with losing. Yeah, and that's a, you know, that's a risk tolerance thing. It's completely up to you. There's no correct answer about that. It's not even a matter of like a trade sizing algorithm, like a Kelly criterion thing, because the amount of money that you could possibly lose probably isn't really related to the amount of money you'll probably lose. So they're different decisions again.
And with the hedged risk reversal that you showed for the equity curve there, is that, I forget with your bullet points, is that hedged daily? Delta hedged daily? No, it's delta.
It's okay. So we assume the target position is a 50 delta risk reversal hedged with 50 stock. We rebalance it, which is essentially equivalent to rehedging it weekly. However, I've done other studies doing it daily, monthly, letting it slop around within a certain delta hedging band and so forth, and it doesn't change the general conclusions. So obviously, if you do it based on a slightly different algorithm, you'll get a slightly different result. But again, we're only looking at one price path history. So you don't want to read too much into that. It's really important that it kind of works in a variety of situations. but I wouldn't like say, well, the best way to do it in the past is hedging every 3 days, so that's what I'm going to do in the future. I wouldn't trust it. I wouldn't trust the future and the past are going to be that similar.
Very good.
Right.
On anything else?
No, actually, the only other thing that was floating in my head is just out of curiosity is if you've combined those two concepts. In other words, doing the delta hedged version, but also with the teeny as well.
I didn't in this. It just doesn't, because I'm looking at trying to make this into a Delta One product, it just doesn't fit within that context. So no, I haven't directly compared that.
No worries. Thanks.
Okay, thank you. Steve Polensky again. In your new book, you suggest strike choice might be driven by the dollar put premium due to volatility skew rather than puts with the highest implied volatility. Is that correct?
That is what I suggest, and I'm not sure I believe it as much as I once did. It certainly gets you in the right ballpark. For indices, it's going to put you in that 15 to 25 delta put range. The reason I don't, it's a pretty good place to start, let's put it that way. And it's also a pretty good trade-off between the most edge, which is selling the ones with the highest volatility premium, which because of the skew is typically going to be very, very low delta options, and the best risk profile. So yeah, I kind of end up in the same process, or sorry, the same part of the curve still, but possibly for different reasons now. And I'm possibly looking for different things now, but it's a very good rule of thumb.
And I think we better let you go, but Jay, because I said an hour and a half originally, but at most. But Jay Hansen, let's get his question in. Although I can tell him, I can sort of answer it. Well, Jay Hansen says, what principle do you use for determining position size? Now, that's actually a major subject in your book, but is there anything you would want to say briefly?
Yeah, there's a lot going on with that. I'm going to say I use the Kelly criterion, but then I'm going to be really clear what that means. The Kelly criterion is not return over variance. That's an approximation to the Kelly criterion that doesn't apply very well to options for a couple of reasons. The first is that the P&L distribution of options is wildly different from a normal distribution, which that approximation requires. And secondly, the variance itself in options is mean reverting, which again, that approximation doesn't take into account. So I'm going to say I use the Kelly criterion because I'm talking about ways of maximizing logarithmic growth, which is really what the Kelly criterion does. And all of these other things are just specific implementations of it. So yeah, there's a lot in there, but I definitely start with the Kelly criterion. And I keep going back and forth about whether I should write a book on that or not, because there really isn't anything that answers all the questions that I want answered. The problem is I don't have the answers to all the questions I want answered yet. So any book's going to have to wait until I figure out everything. But yeah, that's where I start.
Wow, you're prolific in so many different ways. If people want to keep in touch with you, you mentioned you have a Twitter feed, Euan?
Yes. And I'm not sure what my handle is, to be honest. I think it's at Sinclair Euan. Let me just check. Yes, it's at Sinclair with a capital S, Euan with a capital E.
Okay, well, could somebody look for that and paste it into the transcript to verify us that we got it right? And fantastic. And we've taken a lot of your time, Euan. I don't want to abuse the amount that we asked for. And
okay.
Are there any other points you'd like to make, or are there any efforts you're looking for subscribers to?
No, not really. If you follow me on Twitter, you'll see the blogs I write for the business. I'll post the links there. I mean, I guess all I'd say, if I had to summarize what trading was all about, is find an edge and then know why the edge is there, and then everything else will flow from that. It's like you'll know what structure to do. You'll get a much better idea of when it's not going to work. You'll get a much better idea of the sizing process to do as well. But you've got to start with that. You've got to find an edge.
Absolutely. And by the business, would that be whole tactical?
Yeah, whole tactical asset allocation. Sorry, asset management.
Asset management?
Yep.
And what is their business?
It was set up by Blair Hull, who was one of the the original floor market makers who made an enormous trading firm from that. And it's essentially an asset allocation, it's a money management firm that, well, I mean, we trade basically S&P options and VIX options and equities.